Welcome to the Finance Garage podcast, your go-to podcast for navigating the world of finance. I'm Jonathan, your financial guide, bringing the latest market trends, investment strategies, and financial news that matters to you. And by the way, I'm also going to share my other passion, which is cars.
At the SWU Group, we help everyday families achieve financial success. Our integrated services include financial planning, accounting, credit advisory, and estate planning. We're here to guide and support you every step of the way, from custom investment strategies to maximizing tax efficiency. We ensure your financial goals are met with peace of mind. Visit simonwu.com.au for more information.
Hey everyone, and welcome back to another episode of the Finance Garage. As always, Jonathan Wu, Principal and Senior Financial Advisor here at the SWU Group. And today I was fortunate to have Hugh Selby, who's the Co-CIO of Talaria Asset Management, with me in the studio to talk all things alternative global equity investing. As we all know, in the current climate, and because of many years of very low interest rates and money printing, especially due to COVID, we have seen markets, and I mean share market valuations, shoot up to extreme levels. And as prudent financial advisors, we have been concerned about this phenomenon for some time. That has prompted us to look at alternative ways of investing in global equities, and that's when, after a long period of research, we had a look and started talking to the guys over at Talaria. Now, Talaria is a global equity manager, but as you will hear from Hugh, that they do take a different approach and that they're not macro investors. They look and start with valuations, and they take a bit of an alternative or unique approach in reducing downside volatility. Now, obviously, I don't want to take or steal Hugh's thunder, and so I hope everyone enjoys this episode as we look at different ways of investing in global equities, but also as part of our discussion, Hugh shared with me the structural issues that are sort of underpinning some of these risks on a forward-looking basis, and things that investors really should have a look at, or at least should ponder when they're designing their own portfolios. As always, remember to listen to the disclaimer at the end of the episode, and remember, this is not financial advice and for entertainment purposes only. Just a quick reminder to like, subscribe, and follow the Finance Garage podcast on your favorite platform. Right now, we are on Apple Podcasts as well as Spotify. Furthermore, we are now hosting our podcasts on the SWU Group YouTube channel. So Hugh, thanks very much for joining me on the podcast today.
Oh, I'm delighted to be here. Thank you very much for having me.
So just to jump straight in, you're one of two co-CIOs at Talaria. Tell us, who is Talaria and what's your approach to global equities?
So we're an Australian-based asset manager. We run about $2.8 billion across a whole range of clients in Australia and in Asia. Our approach philosophically is, firstly, you need to have multiple sources of return to give yourself the greatest likelihood of being able to achieve your financial goals, which is kind of growing your real wealth over time. I think the second key thing is that we want to absolutely make sure that you lose less when the market goes down. That's important for the journey, because money's only what it enables you to do, but crucially from a wealth creation point of view, it means that you've got more money working for you in the ups. And I guess the third key thing is, whatever asset class you're in, you're taking on a whole range of idiosyncratic risk. So, is that a good deal or good equity or good credit, corporate credit? But anytime you put your money to work in any asset class, you're also taking on a whole range of really difficult to forecast things that impact the return profile. So think about, top of mind maybe geopolitics at the moment, you're taking on regulation, you're taking on inflation, monetary risk, growth, and so on. So we have a unique approach to managing our clients' capital, and that means that every equity starts life as a put option, which means that we're paid upfront day one for putting our investors' capital at risk.
Okay, let's sort of break this down into sort of parts. So, because a lot of your returns are generated from income, right, through multiple sources again, most people, if you ask them, how do you derive income from shares, it's just dividends, right? But you sort of take a different approach. If we start to talk about options, let's take one step back. What is an option?
Great question. An option, simply the way that we use them, is simply making a promise to own a share sometime in the future. Now, that's typically 2 months' time for us. And in return for making the commitment to own a share that you think is mispriced, you get two things in return. You get to commit to buy it at a lower share price than it's trading at on the day that you make that commitment. And you also get paid a premium in return. And that's how you're getting paid upfront for putting capital at risk. But at heart, it's nothing more than a promise to own a security sometime in the future.
Okay, and you're doing it on the put side, because there's put options, there are call options.
That's right.
So explain how the put option works.
So we spend all our time analysing individual securities, so companies in the global equity market. And then once we've deemed that that security is mispriced, and we use a fairly traditional value approach to security selection that many people have used over many decades, we would then simply sell a put option, which is exchange traded and doesn't use leverage. So we're putting the money aside to own that security typically in 2 months' time. And as I said, that means we get to, if the stock's trading at 100 today, if we were just a long-only global equity manager or long-short in the hedge fund world, rather than simply buying the stock at 100, if it was trading at 100, we would make a commitment to own it in 2 months' time, and we would be able to do that at $96 and get paid an annualized contracted rate of return.
So to be clear, that is one, if we call it sleeves, that you're targeting 15% on that sleeve.
That's correct.
Yeah.
So over the life of the firm, and I should say that we've been running this, we only run one strategy at Talaria. We've been running this strategy now in our 20th year. And per $100 of client capital over that 20 years, about $50 per 100 has been in direct stocks and shares. Around $35 has been cash backing the commitment to buy shares we want to own at this contracted rate of return. And then we've had about $15 of unencumbered cash because we can quickly take advantage of increases in uncertainty in the market.
Okay. And so why does the sum of those three parts create a smoother journey for the investor?
Yeah, so let's step back philosophically. Why run money in a different way? There has to be a philosophy behind that, and the philosophy is really twofold. I've touched on we want to get paid upfront for putting capital at risk rather than hoping to generate a return on that. But I think step back and think everybody who's got a corpus of savings, be that a single family office, a charity, an endowment, a foundation, or my mother who's in retirement, has liabilities that they're trying to match off that savings pool. So in my mum's example, that would be travel, paying for grandkids, Christmas presents, or if it's the Cancer Council of Australia, that is to continue to be able to fund these research projects with certainty going forward. To do that, you need a number of things. Firstly, you need to have multiple levers of return because certain asset classes go for a long period of time without generating any return.
Correct.
So I think given the recent experience of a lot of people in global equities, for example, it's easy to forget that from 2000 till well after the GFC, in nominal terms, the S&P was the same price.
Correct.
So you don't want to be just reliant on the shares going up. Okay, so you want to have, the more sources of return you have, the greater the opportunity to be able to match those liabilities. That's the first thing. The second key thing is, of course, investments can go down. So sequencing risk is a real risk. And the key thing is to make sure that you lose less when the market goes down, partly so that you can stick to the process that you're following to realize your long-term goals, the matching of those liabilities, but equally so that you've got more money working for you in the ups. And the third key thing when you're thinking about matching your savings with liabilities is you want to do that with the greatest certainty, so the lowest volatility relative to being able to reach your goals. And finally, you want to do that with the greatest liquidity. And that philosophically is why we run money the way that we do. For example, that $35 per 100 at a contracted rate of return of 15% that I referenced, straight away gives you around 5% return per annum. But crucially, when uncertainty rises, which typically corresponds to the share market falling, markets hate uncertainty, I think everyone would kind of be used to that phrase, means that lever of returns actually goes up. And so that counteracts that downside component of return on the stocks and shares or the equity market, and therefore creates that much smoother journey.
So there's obviously multiple ways of managing global equities. You've got long, you've got your way, you've got long short. I mean, different people value certain things, and I think you sort of hit the nail on the head where you said the last 3-4 years everyone's been somewhat complacent around the way that the equity market has gone. And to sort of give a bit of genesis as to why we sought you guys out, because we actually met we met Chad probably about 15 years ago. And at that point, you guys didn't fit what we were looking for. But in the recent years, you have met what we're looking for because of what markets look like. I think because people have seen equity markets go through the roof, buying blindly, and everything's going up, they think this is forever. And so therefore, what you guys offer, there is always an offset, right? And the offset is that if markets continue to do, let's say, for example, the S&P 500, for whatever reason, goes from 23 times to 28 times earnings, your way of investing doesn't follow that suit, correct? Like it's not going to capture all of that skyrocketing performance. And it shouldn't, right? Because of the way that you invest. Do you ever feel, especially in the last couple of years, do you feel any FOMO? Or have your clients felt any FOMO?
I can't speak for the clients. I mean, I think everybody, what I always say to people is that the hindsight fund is closed because that performance is fantastic.
Yes.
No, I really don't. I think that the secret of compounding long term is to have, be that on your personal finances or in a strategy like we run at Talaria, is to be comfortable that the trade-offs means that whilst you capture the majority of the ups, that you significantly outperform when markets go sideways or down, and therefore have more money working for you in the absolute. So no, I mean, I think the FOMO element has not been an issue for myself or the team. It's about the continued execution to the highest standard possible, recognizing that today's starting valuations, particularly in the US market, mean that the further out in history, into the future you look, the opportunity cost, which is what you're getting at, of how we run money, is actually one of the lowest ever. So that makes it very simple, ultimately, to be able to follow the process that we've done for nearly 20 years.
Yep.
In terms of of clients suffered FOMO, I think you'd probably be closer to being able to answer that question yourself.
I mean, I think if we think about your regular retail client or even your high net worths, everyone has a parcel of CBA shares. And I don't think anyone doubts the quality of how well CBA is managed as a business. I think everyone just has a problem with the valuation, right? We're sitting here today in an environment where, and when I actually share this anecdote with clients, they're actually in shock. Because to be fair, I was in shock when I first saw it. If you combine the market cap of ANZ, Westpac, and NAB, it's still smaller than the CBA. That's quite scary. And as I said, you can't have the classic big four banks in Australia, and the biggest one is bigger than the next three combined. That's a big difference in 10 years. Because I always remember my portfolio managers in Hong Kong, where we used to run our asset management business, they always said, remember, Jonathan, there's never anything in the world called a bad investment. you just pay a really bad price. And this is more a bond manager, but he said, if a piece of crap was priced worse than a piece of crap, that could be an attractive investment.
Yeah, I think there's a number of things that really resonate there with me, Jonathan, which is there is no asset so good that actually it can generate a good return if you pay the wrong price. And there's no asset so poor that actually it can't be a good investment. And people get confused between the two. So the way that we think about it in the portfolio sense is we have the highest quality that we can afford. That's the first thing. I absolutely agree with the longer term perspective, which is people should keep in mind that as a percentage of household worth, equities have never been a larger component ever.
Yes.
The second key thing is that they have never owned those equities in as great a concentration in a single region of the world, which is the US. And the level of concentration within that market, so the largest 10 stocks, how much they speak to for the market, has only been exceeded once, which was in 1899. Okay. Now, the reason that I highlight those things is you cannot manage risk after the fact.
Yes.
And the reason that we particularly focus on the price that we pay for the asset is our belief ultimately is that the best defense about a poor long-term outcome is paying attention to the price that you pay for the asset. And, you think about that. I mean, it's an unfortunate story, but anecdotally, what I've been saying to the people that we work on behalf of is if you were to build one of the most expensive real estate markets in the world, in one of the driest places in the world, in a eucalyptus forest, that does not seem a particularly sensible thing to do. But of course, it didn't matter in 2023. It didn't matter in 2024. And then suddenly, right at the start of 2025, unfortunately, half of Malibu's burnt down.
Yes.
So I totally agree with the assertion of your colleagues previously that if you can't manage risk after the fact, you need to proactively recognize that the long-term returns from where the majority of people's capital is in global equities, which is the US, the maths is sufficient to tell you that the further your visibility long-term and your goal, the less likely you are to generate a positive real return from today's starting valuation. Now, the path to that is the uncertainty.
Yes.
Your example, hey, if we go from 22 times, does that mean the market can't go to 25? No, of course it can't. Or 28 or higher. But it's about trusting the process. It's about trusting the maths. And that's really why you lean on diversification and continue to recycle cash from overpriced assets into relatively better priced assets. And that will give you the greatest opportunity to be able to satisfy your long-term goals.
I was talking to another fund manager recently, and he was talking about, again, to your point, being well diversified. And he sort of used this as a sort of a bait question with advisors when talking about you're not investing in, let's say, emerging market equities, for example. And he said, imagine we were at the really strong part of the mining boom in Australia, and 65 to 70% of your equities exposure was in BHP, Rio, and Fortescue. They've done really well. Would you diversify? And the advisors all said, oh, of course. I go, so why are you not diversifying Mag 7? And then they can't answer the question.
Yeah, that's true. So I think that's a really interesting point. And you talk about FOMO, and you're asking about us at Talaria. You were talking about, how do we find our clients? The reality is that for a lot of asset managers and people allocating capital, is that career risk is a real risk.
Yes.
And therefore, the ability to be privately owned, single strategy or boutique actually is tremendously positive in that regard because, people want to stay in business. They love what they do. As of today, for example, or when I started in the UK in the mid-90s, the FTSE, about 17% of the FTSE was represented by BHP and Shell. So you needed $17 per $100 in those two stocks if you had no view. And it's similar today if you think about the largest 10 stocks, if it's 30 or 35% of world market capitalization. If your promise is to outperform without any adjustment to, without any reference to risk, and capital at risk and long-term returns, then if you had no view on those 10 largest stocks, you would have $35 per 100. Otherwise, if you've got $30, then you're actually taking a big risk in one sense. But of course, that's what forces people to allocate to securities and ultimately stay close to the benchmark. Whereas actually from a distance, the Fortescue, Rio, BHP, it's clear that you should not own those in the same concentration. But the career risk is often underestimated as a true driver of decision making and fund management.
Unfortunately, I think that's now been exacerbated locally here with APRA stress tests, right? Where industry super funds are basically going, well, they're being told by APRA, you guys can take asset allocation risks, not a problem, as long as you get it right.
Yeah, I have a real issue with. There seems to be a number of products and services where they are outcomes based.
Yes.
And they are being asked to be performance based. So if your goals are being met year in, year out, why should my mother care about whether she could have done better?
Yeah.
My mum doesn't sit there, and she's very sophisticated and clever, and you know, I have a tremendous amount of respect by her relationship with kind of, you know, financial markets and savings and money generally. Were she to be in one of the super funds, there is a forced nature that she is being asked effectively to be someone that judges on something that isn't part of her criteria.
Correct. Because every client that steps into our offices here, right? First thing I need to define is, what do you actually want to achieve? Because if you want to achieve 12% per annum, well, there's a risk profile for that.
Indeed.
Right? And there's a way of investing to get to that. There's a level of volatility you need to absorb to get to that. Whereas if you're after 6%, then the path to that journey is very, very different. It is not about trying to pick something off the shelf, which is generally what industry super funds are offering, right? And then to your exact point, I haven't thought about this way, outcomes versus performance, is that everyone does have an inherent benchmark. I've got lots of people that have got no understanding about financial markets, and they just literally come in and go, Jonathan, I need you to outperform term deposits, because that's all I invest in, because I don't trust the share market. I need you to build me a portfolio, could include equities, right? But I just need, you to outperform after fees a term deposit through the cycle.
Yeah, indeed. And this is where we started when I was talking about the different strategy in terms of the reason that we run our clients' capital in a very differentiated way, is that when you have that mindset of an endowment, a charity, a foundation, that sort of perpetual mindset, like I said, you are just trying to achieve the objective in terms of the outcome of continuing to fund the university endowment, for example, with the greatest level of certainty and the greatest level of liquidity. You're not interested if you could have done better or worse. You're just interested, are the needs of the corpus of savings being met? And, we could talk about why maybe this consolidation and performance test is coming in, but that's really more a structural, macro-prudential element. I think about the long-term aims of governments around the world to effectively fund themselves from private sector savings.
Yes, that's exactly right.
Ready to take the first step in investing, or just looking to continue growing your wealth without being inundated with financial information? With SWU Online Invest, we offer a range of expertly managed portfolios designed to match your investment needs. Whether you're a seasoned investor or just getting started, know that we will work tirelessly to ensure your investments are strategically positioned to maximize your goals. Visit swuonlineinvest.com.au today.
Let's talk about two sort of bigger themes in the market at the moment. One being the tech rally. I recently listened to a fund manager on stage last week, and it was a growth equities manager, global growth equities, and he said, we finally, in the last quarter, we added NVIDIA. We finally got there, right? Our valuations finally got there. How have you invested or have invested in the last couple of years with this whole tech rally boom? How has that been a lived experience for you and your team?
It has made absolutely no difference to what we do at all. So there are always shares that you don't own. I think the crucial thing in that space, technology in particular, is that our security selection is really done off a framework of how much cash can be generated in a what we would term normalized environment. So that's normalizing for all the associated costs that perhaps aren't calendarized, but also the amount of working capital you need in a business, how much you need to continue to invest in facilities and plant and property and all that good stuff. But we do that off the existing asset base, and that crucially means we're not prepared to pay for growth. And therefore, a number of these businesses, which are some of the best businesses that we've ever seen, they're fantastic. No one's arguing whether they're good or bad businesses. We're saying that our process doesn't follow that so they have sufficient criteria to be good investments.
Correct.
So it's actually been very easy, because we follow a disciplined approach about where we spend our time looking for new ideas, and a range of these securities have simply never been there. And therefore, I haven't spent too much time thinking about that at all. From a point of view about Talaria and the role we play in our clients' portfolios, the value, ironically, has gotten bigger because of some of what I was talking about, the starting valuations, the concentration risk, and in this small cohort of stocks. Because what you're trying to do is, of course, give your overall portfolio as a saver the greatest opportunity to meet your objectives. And with the greater and greater level of concentration and the amount of money spoken for in a smaller amount of stocks, the need for diversification has actually only gone up. So 2022 is a good example. So this is what we would call basis point risk, which is actually where in a global index or Australian index, that a smaller and smaller number of stocks actually represent the greater and greater level of overall risk in that index. So you referenced CBA, and that's a well-discussed security in the Australian market. The Australian market is very, very concentrated. It's one of the most concentrated in the world. And what that means is the market outcome is actually only really a comment on a small number of securities outcome. So for those who were invested or remember, say, the period 2000 to 2002, what's the practicality of that basis point risk? What that is during that period, the market went down over 50%. The US market went down over 50%, but well over 40% of shares actually went up over that period. And we've started to see that now, where the outcome of a global index or a US index is actually really only a comment on a smaller and smaller cohort of stocks. And therefore, the benefit of other ways of being able to generate returns and complementary in terms of different securities, sectors, so we're talking about tech, but also return types, has actually only become more valuable in a portfolio context. So actually, in some ways, it's been helpful.
For active managers.
For active managers.
Yes.
Yeah, absolutely. I mean, listen, you're taking on that basis point risk as a passive component. The irony, of course, is the more expensive something becomes, the more money is going to it. And I think everybody intuitively understands the higher the price. Like, we'd all like to buy a house by the seaside, but compared to a 2-bedroom apartment under the runway flight path,
yes,
as an investment. But it depends on the price that you're paying for those two things.
That's
kind of the point.
With regards to the forward-looking risk of geopolitics, and I like to call him Agent Orange, that's my nickname for him. How has that played into your team's mind? And what's the practical realities of that when you're analysing companies? So, for example, I've interviewed every manager that's in our core portfolios, and I asked them, how do you incorporate tariff risk into your analysis? So, for example, I talked to the guys at Antipodes about Asia, and they said basically we just take any company that is selling to the US and mark the US sales portion of their business to zero for the purposes of being ultra conservative, right? Because that manager is a value manager like yourselves. How have you factored in the Donald Trump risk and the tariff risks on a go-forward basis?
Yeah, so there's a couple of ways to answer that. So from the bottom-up security selection, clearly that's actually about the relative competitive position. It's very similar to the way that you would incorporate FX risk.
Yep.
So if there's big FX risk, depreciation or appreciation, there's two ways that translates through to the cash flows of a company. The first is translational. That's simply that a unit of sales in in the US in this instance, say coming back to an Australian company, translates at higher or lower for the Australian returns. That doesn't really matter because it doesn't change your competitive position. The crucial thing is, what about the transactional impact? How much am I starting to be producing in one area that's now become higher cost relative to lower cost? So that's relatively easy, and it's not that different to a transactional way of looking at the FX exposure of our various kind of global companies. And most of our companies are pretty global, or many of them at the moment. So that's been quite easy, albeit obviously we're dealing with uncertainty in terms of what the actual tariffs, and we're starting to see that come through. So that's just a direct impact about the competitive positioning and how that would then change the profitability and ultimately cash flows that come off the products, depending on their regional mix. How we're dealing with it emotionally and at a bigger picture is, I think, what we've been writing about quite a lot about recently. The analogy I use is that, I have two children. If my child has chickenpox, I don't try to divine any meaning from the pattern of the different spots as they emerge on my child's body. Mm-hmm. So there's a new, chickenpox sprouts on the elbow. Does that mean something different to if it sprouts on the hand? Yeah. What we of course do is look at the underlying kind of virus and so on, whereas these things are simply a symptom. I think many of what we're dealing with, and it's been an extremely noisy year, the flood the zone is a strategy, right? Let's put so much news and material out there that it's difficult to focus on what's important, masks the fact that many of the pronouncements that we're seeing globally are simply symptoms of something that has a much greater implication, and it's easier and more important to focus on that implication. So what's that? We have seen, say going back to 1800, a whole range of different monetary regimes. That's just the current account, where things are produced, who benefits from it, and who's effectively, in deficit, and where does the money flow to compensate from that. So we had the gold standard, we've had the Bretton Woods standard, and really what we saw at the start of the 90s is we saw what we would term the era of globalization. It was the end of, the Berlin Wall coming down, so we had about 350 million people come into the global economy. And then crucially, Deng Xiaoping in 1994 obviously talked about prosperity in and of itself not being a negative. And we saw China and many parts of Asia really come into the global economy in a way that they hadn't participated before. So the the World Trade Organization only came into existence in 1995. I mean, it feels like something we've always lived with, but it's relatively recent.
Yes, it is.
So these ebb and flow, this monetary regimes and how global trade operates and where things are manufactured and so on. Now, it had two tremendous benefits for asset owners. If you think we're going to buy an asset, if you know the return we want, you have perfect foresight in the amount of cash flow that comes off that asset, and you have perfect foresight in the cost of finance associated with that asset, you know exactly the price to pay. Correct. Obviously, the world's not like that. Yep. But what has happened in 1994 to really the 16-17 period, and it's accelerated, is that if we'd sat here in 1994, the cash flows that have come off a whole range of assets has been much better than we would have forecast. Yep. Because of this era of globalization. Yes. Partly because it's spurred growth, and of course we've seen a tremendous number of people enter into the global economy that weren't really in effect in the global economy in the late 1980s. But equally, we've seen the cost of manufacturing collapse as well, as we've all benefited from disinflation in a whole range of goods and services. And that has meant that making a unit of sales has been cheaper. So 8 out of 11 sectors have seen their gross margin per unit of sales, how much expand. And that has meant the nominal cash flow growth is better than we would have forecast. At the same time, we've seen this huge recycling of this change in the global economy in terms of cash that has suppressed the cost of finance that we would have used in the early 90s. And that has just gone down and down until about 2022 when we saw that big inflation increase. So that has been a positive jaws. So if we go back to that first principles, what return do I want? Well, as long as I kind of estimate the nominal cash flow and the cost of finance, well, both of those things have gone positively in the asset owner's direction.
Correct.
And so that's why if you look at a whole range of corporate credit, if you look at real estate, and if you look at global equities, particularly in the US, we're at very, very high valuations than we would have been 10 years ago, 20 years ago, and 30 years ago. And rightly so.
Yes.
What that has meant is that less and less money is being spoken for that uses valuation at the heart of their process. You name-checked one, the huge rise, obviously, in passive investment. Explicitly doesn't use valuation. In fact, capital flows to things that are more expensive over time. And many active managers have de-emphasized valuation as a core component of actually what it is as part of their process. So people are aware of the target reserve balances or global liquidity or injections into this and so on. We think that that is a mistake. Mm-hmm. That what people should be asking, not de-emphasizing valuation as part of the decision-making process about where to put your savings, they should be saying, are the conditions still in place that allow that positive jaws?
Correct.
We would contend that associated with all these benefits I've just talked about, particularly to asset owners, but also, cheaper in real terms, many goods and services, obviously tremendous. The number of people who have been risen out of poverty over the last 30 years has never been greater in history. All these fantastic things. But it's also come with rising structural imbalances.
Yes.
Now, 4 of those particularly mean that we're trying to negotiate our way to a new era. Post that globalization. And we've always seen that over history, ebb and flow. I name check Bretton Woods and before that gold standard and so on. What are those 4 big structural imbalances that have been able to grow alongside these benefits? The first is that the world has never had more debt than it does today.
Okay, scarily, but yes.
Now, obviously that is not in the private sector, that is in the public domain. We've socialized debt all over the world. So people easily lose sight of the fact that we've never had more debt. And that has been a function of this falling cost of finance. So, the service charge has been lower and lower, and now we've seen a big spike in that. The second is really these continual structural deficits as you've seen this capital recycle. So the US economy last year required $2 trillion of private sector savings. Your client's money,
yes.
Right? And we're seeing a pushback against that. So we've never seen deficits outside of a recession as large as we are today. But the US requires $2 trillion as of last year of private sector savings every year continuing to go in to fund itself. So, the change in the future fund mandate in Australia is a good example where the Australian government is starting to say, all else equal, we would like some of those private sector savings, because that is effectively, government employees' pension, to be retained in Australia to advance our own objectives. And that's true of countries and regions all around the world. They're starting to recognise in a deglobalising world, actually we need the private sector savings to be retained here.
And self-reliance.
Absolutely, yeah, exactly. It's exactly that. Be that supply chains, but be that European defence and so on is an obvious one. The third big structural imbalance that we've seen a real re-engineering of the global manufacturing base. So, in the early 90s, so China is now well over 30% of the global manufacturing base. And we saw really through COVID, but before that, is this very narrow and long supply chains in certain industries in general and over-reliance in a single country or region, is that really strategically sensible, both as a company, but also in aggregate as society? Do we want to be, totally reliant on one region for the manufacture of pharmaceuticals?
Yep.
And there is a change there. And then the fourth key thing, and it goes back to that asset valuation, and this is where the rubber hits the road, as in the first 3 we could have said, well, that happened 5 years ago or 10 years ago, why now? Is that you've seen such a disproportional return from these things between returns to asset owners versus labour in general.
Yes.
So real standards of living for those people who work for a living have gone down. The real standards of living for people who own assets have simply gone up.
Correct.
And that has obviously resulted in a rise in populism all around the world. So you look at France, Netherlands, Eastern Europe, Hungary, Poland, and of course, with the change of US administration, really in 2016, but then a continuation with the Biden administration and then the recent election in the US, has meant that there is a political will now to address some of those structural imbalances. And that has big implications that if that Jaws effect that I talked about comes to an end, you are no longer, as an asset owner, being able to rely on selling at ever higher price valuations, not prices, ever higher valuations. So to put that in context, the US market has done over 10% per annum over the last 10 or 15 years. Been very strong.
Yep.
But that has predicated on exiting at a very relatively historically high multiple.
Correct.
Now, if you use the 20-year average multiple on a long-term measure of valuation in the US, rather than get over 10% per annum, you would have got 7.3. So going back to this idea of, are the preconditions of that positive impact of rising nominal cash flows and falling cost of finance, if they're not still in place, at the very least, then we've just got that at slack tide.
Yes.
We don't even have to talk about the headwind where it could go the other way.
Yep.
Then your returns are going to be materially lower.
Correct.
And therefore you need to be focusing very much on valuation, focusing very much on companies being able to self-finance, because capital is starting to be fought over, this retention of private sector savings within region and within countries. And you need to make sure that you are not susceptible to, on margin, a more inflationary environment rather than less inflationary environment that we've been used to.
So here's that next point. If I was to ask you to prophesize, what would cause that Jaws to reverse? Is it inflation, going back to where we saw in post-COVID, and it forced 13 straight rate rises here in Australia, or we saw from 0 to 5.5 in the US 10-year? Is that what the trigger is, and then that would change the course of how capital is allocated? Because that would, if we were to compare a strategy like yours to a long-only growth techie fund, that's when your convergence of returns are going to look more similar, because these guys are going to be more muted in that sort of environment. Cost of capital goes back up again, materially, inflation is high. Is that where you think is going to change the course or change the tide?
Well, if we go back to, listen, it's not about, we don't forecast the future, it's more about what are people doing and what's embedded in the price. That's the key thing, I think, which you made the point as well. So we know that in global equities, 70% of global market capitalization is positively correlated with the price of bonds.
Yep.
That's never been higher. So that is that people are already positioned for an idea that bond yields will go down, and what we've seen in the past will continue into the future. So if you're not confident in a 7 out of 10 or more that inflation will not pick up because of demographics, right? Labor is one of the greatest shortages that the world is now facing. If you're less than 7 out of 70% confident that this fight for capital is going to mean that rates will have to rise, all else equal, so the term premium, the compensation for what may happen in the future, then you have too much money allocated. You need to be more than 70% confident, otherwise you are over allocated relative to what might come.
Correct.
And our view is that there are structural reasons to believe that the inflationary backdrop of the last 15, 20 years, that disinflation, has, at the margin, unlikely to see the same conditions going forward. And therefore, the question is, what are you doing about it? The reason is re-engineering of global supply chains. I mean, that is an explicit statement, clearly, that the US government is kind of trying to target, bring manufacturing back into local. Well, that is expensive and on margin more inflationary. I mean, corporates moved their production facilities to different places in the world outside of many developed markets because it was cheaper. Yes. And that's why they did it. The second thing is that there is clearly a requirement to re-engineer the global energy mix. That is tremendously expensive. And the third key thing is that we're seeing labour really now as, if you think of that 350 million people who came in from Eastern Europe and the kind of Asia manufacturing base in terms of human capital, on margin, that is now going to go down. So all of those things are more inflationary, not less inflationary. And therefore the question is, what are you going to do about it?
And what are you going to, and how are you currently positioned from a portfolio standpoint?
Yeah, we don't.
Right?
We haven't been positioned any differently.
Okay.
Okay. We are a beneficiary where we've always emphasised strong balance sheets. As equity holders, you're subordinated in the capital structure. You are the first cab off the rank to fund companies. So in the world that I'm describing, where there's this fight over money between governments and their private citizens, then actually being able to self-finance will only become more important. So there's no change from that perspective. And secondly, what you want to do in that environment is make sure that you are paid back sooner rather than later.
Yes.
So, the idea of I want to get my money back in less time, not more time, far into the future. And as a value manager in terms of our process, we already have a relatively shorter duration.
Yep.
Now, what does that mean? A starting valuation PE of 12 times means you get your, cash, means you get your money back in
12-year time.
Yeah, as opposed to the market, as you said, 20, 21.
Yep.
Exactly. And so that's the difference. Okay. So we would think that the market will have to allocate money into shorter duration just simply to be cognizant without even making a call that is a potential outcome that they need to diversify away from.
To sort of close things off today, Hugh, if someone's looking at investing in global shares today, looking at the environment that we've just discussed, what would you think is the biggest mistake they should avoid?
Well, past performance is no promise of future performance. So I think that there are many regions and companies in the world that are attractively valued. So think structurally about what I'm talking about. We're suggesting that a whole range of assets, for example, regions, but also types of securities, have been subjected to these global forces. That means they've been incrementally getting lower returns. Suddenly in a world where you start prioritizing local supply chains or security of supply, then there's a reassessment that actually that is the kind of asset where no longer should I be thinking that every incremental dollar is at a lower marginal return. And that's actually how you start to get a reassessment of the medium-term profitability. And many of these assets are fairly asset intensive and so actually would benefit from a slightly higher inflationary environment because the replacement cost of those assets starts to go up. So there's no better example of that than, the European defence industry. They have had a defence industry for as long as I've been in markets from the 90s. They were hiding in plain sight. There is then a reassessment of, in this deglobalized world, that we're going to have to look after our own economic and security needs, and these assets have tremendously re-rated because of the future prospects. So I think there's many sectors and types of assets that have been net losers in a return sense from globalization, that even if that came to an end, are priced for a perpetual decline. So that's one area. And the second key thing is there's certain regions as well that have been big losers over time because of that and are very attractively priced. So it's probably to look in areas, first off, that have a decent starting valuation, and they're probably not the ones that are in the mainstream area where people have been looking.
Fantastic. Well, Hugh, thank you very much for sharing with us your worldviews and how you invest. I hope to see you on the show in sometime in the not too distant future.
Oh, thanks so much for having me. Yeah.
Thank you.
This podcast is not financial product advice and is intended to provide information only. It does not take into account the investment objectives, financial situation, or needs of any person. You should assess whether the information is appropriate for you and consider talking to a financial advisor before making any investment decisions. Any investment examples are for illustrative purposes only. The information is taken from sources which are believed to be accurate, but Simon Wu, Jonathan Wu, SWU Financial Planning, and Personal Financial Services Limited accept no liability of any kind to any person who relies on the information contained in the podcast. Unless expressly stated, none of the information should be taken as a recommendation. For more information, please visit www.simonwu.com.au.